Wealthy and Wise is your guide to value investing, powered by Teaminvest.
Welcome to this week's edition of Wealthy and Wise. I'm Nadine Blaney. Well, defense stocks are booming as governments ramp up military spending and geopolitical tensions rise. But does a powerful theme automatically make a great investment? Well, this week on Wealthy and Wise, we look at defense through a value investing lens, separating stable, long-term businesses from hype-driven momentum trades. And in head-to-head, we will delve into major global and Australian defense stocks, and we will answer a viewer question. So let's begin by adding some value. Well, the defense sector is ultimately backed by government contracts, which can run for decades, providing revenue predictability, one would think. That is rare in other sectors. But what if you lose those contracts? Defense stocks also face political and ethical risks, and projects can run significantly over budget after a very competitive tender process. But let's get the experts in. Joining me now is Teaminvest's Andrew Coleman and Peter Hasrouni. Welcome. Nice to see you both. Peter, I am going to start with you because I've been told you're a bit of a defense expert. Lately, when we talk defense, I feel like we're talking drones. So just give us that sort of overarching view of what constitutes the defense sector.
It's actually a very large sector, Nadine. You think about it globally, well more than $2 trillion. And I think drones are particularly topical for the two current wars that are happening in the globe right now, well, the larger wars. And that is that they're overwhelmingly being fought with drones in a way perhaps they hadn't been fought with before. But if you think defense more traditionally has typically been kind of very large, shiny metal objects, either in the air, in or under the sea and on land. And they've been the ways we've traditionally described defense as kind of land, sea, air, and kind of joint domain where all of those work together. So
the industry is massive. Is it possible to give us some sort of scale of the size and scope of the industry?
Yes, I think globally it's more than $2 trillion US. The US alone spends nearly $1 trillion, notwithstanding the changes that are coming before Congress. And then you think the rest of the large nations of the world spending between 2 and 4% of GDP. It's a rather dramatically large number. And it works across from building things, what we would call acquisition, to sustaining things, which sustainment maintenance.
Yes, because that's the thing, Andrew. When we're talking defense, we're not just talking drones or big metal shiny things, but it's sort of the services as well that support that whole industry as well. So you could think IT, manufacturing.
Yeah, I mean, if you think about it, the purchase of one submarine is a very large number, but keeping that submarine in water and operating is probably many orders of magnitude that over the 40 or 50 or even 60 years of operating life. So I think one of the mistakes that investors, you talked about themes before, often get caught up about is we seize, particularly momentum-driven investors, for people in the market looking for news cycles, seize on the big shiny announcement of who's going to win a sub or who's going to win a frigate or who's going to win a missile contract, and forget that that's only a very tiny portion of the total spend. And the sheer scale of that, I mean, Pete's mentioned that the industry is about $2 trillion US. I mean, to put that in context, that's twice all of Australia's GDP before you take into account FX. So the industry is huge, but it's also dominated by sort of a handful of players. So from that point of view as an investor, it's sometimes sexy and exciting to try and jump into the new cool technology that's going to change the world in defense. But you've got to put yourself in the shoes of the purchaser. These are large governments that have 40, 50-year contracts they want to issue. Are they really going to issue it to a startup based in Adelaide, as much as I would love them to, or are they more likely to give it to someone like a Lockheed or a BAE with the Australian Adelaide operator as just a simple, provider inside the contract?
Yeah, that's a good point. So maybe, Peter, you could talk us through sort of these government contracts, because governments normally pay their bills, correct? But I mean, there's a lot at risk. And it's my understanding, if you take shipbuilding, for example, I mean, governments are always going to want to give it to the group that's giving it to them the cheapest with the lowest margins.
Yeah. So one of the benefits of defense is your customer is able to print money, which is a great counterparty to have. I think, but you're right. The challenge is being on the front page of the newspaper if anything goes wrong can be embarrassing. So certainly governments are trying to save money, but equally the risk of embarrassment tends to be that nobody wants to be on the front page of the news for hiring the maintainer that caused 4 or 5 of the ships to sink. So, yeah, kind of lowest cost, but the most availability is typically the decision matrix of how we choose those sustainment contracts.
Mm-hmm.
How much ship on the water at a time are you promising to give me?
And I would imagine for a company, if you lose one of those contracts, it could be sort of make or break.
It could be a very long time to get back in the market. And if you think about the companies that have the most dispersion or spread of risk across multiple domains that we spoke about a bit earlier, tend to be the most able to survive. And if you're 60 naval, 40% land, and you lose a naval contract and you pick up a land contract, you can survive. If you're a pure play jet aircraft producer and you lose a big one, 20 years is a long time.
That's really interesting and valuable perspective, because when you are thinking about defense businesses, if the sheer amount of dollars being spent on the industry, is such that you can't ignore it really as an investor altogether, is there anything that makes a defense business different in terms of qualities that you look for than any other business? And, the things we've talked about before, stability and the likes.
Yeah, I don't think it makes it any different. And by the way, I do think you can ignore it. I mean, unless you have unlimited money, you don't have to invest in every sector. And I'm sure there are ESG concerns in some parts of it. I have certain concerns with certain defense companies as well, from an ethical point of view. But if you're investing in them purely as a business, it's worth understanding that they have very large dollops of cash they get given. So that always creates an opportunity for good long-term returns. But that those dollops of cash are on cycles that can be pulled away very, very quickly, and often for reasons outside of that specific company's control. So you want to only invest in the defense sector if you understand that, and you're comfortable with the idea that it might take 5, 10, 15, or 20 years to deliver the contract and give you your return, and that in that 5, 10, 15, 20 years, there's always a chance that the rulebook gets torn up and replaced. Because you mentioned on the one hand, they're government customers, which means they pay really well. On the other hand, who do you appeal to if you feel they've treated you poorly? Well, standing in front of a judge and saying you're on a fine yourself tends not to be a particularly good strategy.
Yeah, okay. So those are a few of the cons. And ESG, I suppose, is a very big consideration for many. Biggest pro to investing in defense companies?
Well, you could have 20 years of recurring confirmed revenue.
Yeah.
It typically is a sector of scope creep. So scope creep is your friend. New technologies have to be put into systems. That's always beneficial because you're not bidding for those incremental pieces of work. And also you tend to be involved in larger parcels of work. So scale matters and scale is rewarded in that sector.
All right. Well, that has added some value to the conversation. Now, let's go head to head. So understanding the defense theme is one thing, but valuing the companies inside it is another altogether. So in this segment, we'll go head to head across global defense giants, next generation defense tech, and key ASX listed names, and ask a pretty simple question, maybe a simple question: which businesses actually stack up as investments? So welcome back to Andrew Coleman and Peter Hasrouni from Teaminvest. Okay. I'm going to start with the first group that we've put together, which is American and European primes. So let's start with the global primes. What do we mean by that? And how do those sort of global players differ?
So if you think of a prime, Nadine, it really is the organization whose shins the customer kicks. So that's the person that's primarily responsible for the delivery of whatever the contract is. If it's a new aircraft fighter, is it a new ship? Is it a new vehicle? Is it a new piece of technology installed? That's typically called the prime contractor.
And so is there any sort of fundamental difference between how those companies are run in the US versus Europe, which are the big, obviously, domiciles?
Yeah, they are different. Clearly, perhaps obviously, culturally quite different. I think in the past, it's almost always been you look right to buy material, if that makes sense. But I think increasingly there's a view that there are alternatives. And the focus has nominally been the American combat systems. So irrespective of which piece of machinery you buy, it operates on a US combat system. and we'll discuss them, but that might be up for grabs with what's been happening.
Okay, so we've got some compare and contrast, which is really good when you're going head to head. So Lockheed Martin, which I think many people would have heard from, versus BAE. Maybe just give us this 30-second pitch for both.
Yeah, so I mean, Lockheed famously F-35 manufacturer, almost, not entirely, but a relatively pure play aeronautical company. BAE far more diverse in its offerings. So there is some kind of air domain things, but more Navy and some land systems. I think, BAE from the having a dispersion of revenue perspective, given how the world feels about F-35s right now, I think has a lower risk position in that there isn't just really one superstar product that they're offering.
I'll just get across Raytheon versus Thales, because I'm not familiar with these companies.
Yeah, so Raytheon perhaps has been a bit of a run because they make those two very famous products, Tomahawks and Patriots, which have been in the news for perhaps right or wrong reasons. Whereas Thales, large French naval, not entirely naval, but mostly naval producer, and Thales quite familiar in the Aussie defence sector, done a lot of Navy work. They do a lot of the land armoured vehicles. Again, quite diverse and, again, very different operation. Raytheon and Thales, I mean, Raytheon really is what I call kind of pointy, sharp things, and Thales tends to be more of the systems and pieces of equipment that shoot those.
Okay. I like it. I like when things are explained simply. And then General Dynamics versus Rheinmetall. And I've heard a lot about Rheinmetall. It has had did have a big run, but pulled back quite significantly.
It's actually the closest of the comparisons.
Okay.
They are both large land systems, vehicle type producers. So if you think about what I said earlier about typically was almost always an American combat system.
Mm-hmm.
So in the large European contracts of old, even if Rheinmetall won the work for the vehicles, the kind of combat systems were American. So General Dynamics typically had some interface with the European or UK manufacturers. But how long will that last? Where Rheinmetall will be a true, fully integrated prime on its own may only be a matter of time.
And then the last sort of comparison we'll do before we bring up some of the financials is Boeing versus Safran.
Yeah, so that's a bit of a symbiotic relationship at the moment.
Yeah.
So if you think about it, Boeing builds the tubes, Safran builds the way to move the tubes. So, from a propulsion system is if the European primes can build more and more competitive shells, why wouldn't, a premier propulsion system producer have a wider range of distribution, as opposed to Boeing has been a dominant aircraft producer for a while, in defence space, that is, of course, notwithstanding their civil business. But I think the propulsion system would probably enjoy more favourable tailwinds, given you can put it onto any sort of aircraft hull.
So maybe we can now look at, a bit of a comparison between some of these companies. What are we doing this through, a value lens primarily?
Yeah, I think let's do it through a value lens. We can maybe have a look at them in pairs and just talk a little bit about what they're doing, as sort of Pete's touched on, and how that's then translating to potentially, are they a good investment today, assuming you can get your head around wanting to invest in the defence sector. So I think the first pair, the group that you were talking about, was Lockheed Martin and BAE. So, of course, BAE, big British operator, been around for a couple of 100 years, but certainly in its current form for at least since World War II. In terms of scale, it's about 2/3 of the size of Lockheed Martin. So I think whilst most Australians would know the name Lockheed Martin pretty easily, BAE is not one that's on the radar. And yet here's a company that's 2/3 the size, doing sort of roughly $40 billion a year in sales and making roughly 2.8 billion in profit, growing at double-digit growth rate. Now, I've color-coded this to be easier for the viewers. So anything in green as a value investor is a good sign. Anything in yellow is neither good nor bad. And anything red is something that you would be worried about.
Yeah. Okay.
So if you have a look at Lockheed and BAE, they're both growing well beyond inflation, which, given these are long-term contracts with a nice big tailwind behind them, that's a good sign. If you want to invest in something for 5, 10, 15 years, that's a kind of growth rate you'd like. They've got acceptable stability. You were speaking about it before. The industry lends itself to a high degree of stability. And in terms of price, Lockheed's on a PE of 24 and BAE on a PE of 29, which, it's not cheap, but both of those are well within the range of sort of normal market trading. So if you've got a view that either Lockheed or BAE, big shiny propulsion driven planes and missiles is where you want to play, both of them look relatively reasonable as an investment. There's all sorts of questions about if you want to play in things that explode, but that's a whole other story.
For the purposes of this, we're going to say that we do. So I can see there's some red. I'd call that more of a pale orange, but that's okay. I take your point. Raytheon and is it Thales? Yeah, it looks like Raytheon's not as stable. So you're still applying the same sort of filter to these big mega defense companies.
Yeah, absolutely. So Raytheon's the biggest defense company in the world at the moment. And they're the biggest defense company in the world by market cap at the moment, really because they make the things that explode. And everyone has worked out pretty quickly that if you blow them up faster and faster than you've been blowing them up in the past, that means more work for Raytheon to replenish the stockpiles. And as a result, no surprise, market cap has risen. It's now about $236 billion US dollars, which is not exactly small. And they do in a normal year around 80 to 90 billion in sales. So this is not a small operation. I think the reason it's run up to some extent is people think that that's going to continue, growing rather than diminishing in its need. But having said that, we have been through a period of increased global stability up until the last year or two. As a result, amusingly, over the last 10 years, Raytheon's actually been shrinking. So, if you think about what they do in the cycle, when there's a hot war, Raytheon sells a huge amount of missiles and explosive stuff. When there's a Cold War, and we're all having diplomatic arguments, but thankfully we're not exploding things, Raytheon's really just doing the maintenance and shipping out the old one that's now expired. So since Afghanistan and Iraq, Raytheon has been shrinking. Now, with the Ukraine and the Middle East, Raytheon is growing again. Now, as a value investor, I put that in the too hard basket, because if I can't predict the likelihood of the next war and the amount of munitions that war is going to explode, how do I value the business? Now, I understand there's a whole bunch of awkward things that we said there, but it's kind of what you're doing in this space. Yep. Thales, on the other hand, the big French contractor, is doing the other side of the equation. As Pete says, it's everything except the bit that explodes. So who's doing the shooting? How is it being guided? Who's manning it? Who's actually hiring the people to train them to use it? That's what they do. And so as a result, they've got a much higher degree of stability because those contracts are long-term maintenance, boots on ground contracts. That makes them an easier business to value as a value investor. And then the question you've just got to ask is a PE of 26 growing at 5% attractive or not for the space? And I think that probably, looks okay-ish. It's certainly not jumping up and down, go and buy it tomorrow. But, 2 greens and a yellow is not a bad sign.
Yeah, I see 2 greens and a yellow for Northrop Grumman, and its PE is lower than everything that we've talked about before. So what's going on there?
Yeah, it's interesting. I think Northrop's just being ignored at the moment in the current sort of run-up of defense stocks, which doesn't make a lot of sense to me when you think about what Northrop's doing. I mean, Northrop's the big aerospace and satellite provider, right? So the big stuff in orbit and outside and just below orbit.
Mm-hmm.
As a result, you would think with the rise of drones and everything else that this would be sexy, but it seems to have been that the market, being made up of humans rather than rational actors, has focused on some of the companies we may talk about second, which is the new technology drone, low orbit stuff, rather than the high orbit, which of course doesn't make any sense because they're only powered by high orbit anyway. But as a result, Northrop hasn't had the run up the others have. It's growing fast, as you can see, double-digit earnings growth because of the fact that there's more satellites going up and more low Earth orbit things going up. And it probably, to your point, looks the most attractive on that list. And as do their big Italian competitor, which is Leonardo. So Leonardo does helicopters and low Earth orbit.
Yeah. All right. So let's just skip down to Boeing because even I can see that that doesn't look very favorable. The growth rate is going backwards. Stability is lower than what we can see elsewhere. And the PE ratio is massive. I mean, Boeing, I guess, has to contend with the fact that it's got some pretty bad rep when it comes to just its good old everyday aircrafts, correct?
Yeah, I was trying to work out, do I call it headwinds or a crash? I don't know which bad pun I was going to use. Yeah. But no, I mean, look, Boeing on both their defense and their civilian side of their business has got some major structural problems right now. As a result, earnings are shrinking. Stability is all over the shop. It's big write-offs one year, small profits the next. And I think those who like the concept of what Boeing has have kept the price high. It's still got a $186 billion market cap. Mm-hmm. But, a business earning less than $2 billion in profit shouldn't be able to sustain that market cap.
So, Peter, with all of your expertise, your deep expertise in defense, does that chart that we just had up on screen in the yellow, green, and red, does it sort of coincide with what you know about the companies? Does it make sense?
I think other than perhaps poor, unloved Northrop, mostly, I have a view that in Australia anyway, nobody ever got fired for hiring BAE. So that's a common refrain in Russell head office. Just for that point is 1, UK-based company, 2, broad-based skills, 3, have built and or maintained platforms for decades. I think if you're having a look at Leonardo and some of the other Europeans, you could almost get a nosebleed on the climb for some share prices
Right.
post the new administration for the fact that Europe is probably going to buy European material, and you're beginning to and will continue to see.
Mm-hmm. Yeah, and then you've got countries like Canada as well turning
Right.
to Europe more and
Absolutely.
more. Okay, so let's talk new defense versus old defense. So how are we thinking about that? Is that just a drone story, or is it bigger than that?
I think a little bit bigger. If you think a drone is just the end of the process, so you need sensors, detection, systems, comms. You need a way of speaking to the drone, directing, operating the drone. And I think you also need a way of bringing field information in a way that is compatible with that kind of warfare. I think if you think about, the Ukrainian war, is a huge land mass. They have grey zones where if you walk into those, you're quite some drone risk. Russia's new anti-drone is novel. They just bring in snipers to get rid of the anti-drone operators. But more broadly, it really is that high-end way of having a control center communicate with an unmanned autonomous vehicle, whether it's above the ground, below the ground, or on the ground, and all of the various systems that have to go together to make that work.
And so there's also data, isn't there? And surveillance and all the rest of it. So is that how we sort of think about some of these companies that we'll compare now, like Palantir?
Yeah, so I think if you think about Palantir, and it's kind of the brain, but
Okay.
the human brain in isolation without a body is not overwhelmingly useful. So companies like L3 and some of the other, what I'd call kind of hardware suppliers, are the way of connecting the brain to the various bits of equipment that do what you're trying to get them to do. So, likewise, drones have been in the news, but if drones can't communicate, then they're kind of blunt objects. So that data, that security, that locking down the domain, so to speak, is an existentially important part.
So Palantir versus, if we continue with our little theme, so we kind of get what Palantir does. What about L3 Harris, which is LHX, I think, on the NYSE?
So L3 really is the bits you can kind of see and feel. So, Palantir would have an engine, a piece of gear that's really doing all the thinking. But in terms of what are the inputs? So the sensors, the hardware, the antennas, the various pieces of hardware that absorb information is classic L3. Typically the metal shiny bits that allow that communication to be transferred between parties is typically L3. And then likewise, what converts all of that data, not noise, but all of that input from the field that comes up into an operating system is typically L3.
Okay, so now I'm going to go to you, Andrew. So you want the brains of the operations, or you want the hardware?
I think as a value investor, you don't care as long as it's going to make you money, right?
Okay.
Assuming, again, this is a sector you want to play in. I think it's really interesting. Pete described it quite well there, but the sexiness at the moment, because it's new and exciting, is on the AI piece of being able to operate this. I mean, that we're almost in that world now, out of sci-fi, of unmanned combat systems. People sitting in Canberra and in Washington and in, Kiev, directing these munitions without having to put any human's life at risk on the ground. I mean, in that role, there's plenty of humans at risk when they do it, but not in that specific role. And as a result, companies like Palantir that are providing that software overlay are being very sexy at the moment. And those things like Droneshield, which we'll talk about in a little bit, and others that are making the drones are sexy because it's the bit that we're seeing on the news all the time. The bit that isn't sexy, though, but still exists, of course, is that none of that works unless you can gather intel and feedback and operate them.
Yeah.
Having a dumb drone accomplishes nothing. Having a drone with AI that can't pick up sensors and know what's happening accomplishes nothing. And it was really interesting when we were putting this comparison together of Palantir and L3Harris when you guys were talking, is to have a look at that, because effectively Palantir is providing the software to make those drones and other unmanned items work. But they can't do a thing without the information that L3Harris is collecting. And yet L3Harris is on a PE of 30, having made over $10 billion in the last 6 years total earnings. And Palantir is on a PE of 155, having made a grand total of $300 million of earnings in the same period. Now, the fact that Palantir's market cap is therefore roughly 6.5 times L3Harris's tells you something's going wrong with the way we're letting our emotions drive investing decisions.
Yeah, okay, I get that. That is a flashing red light. Okay, so now, Peter, let's get to ASX defense. Because we're a small country.
Yes.
We don't obviously have the Lockheed Martins, the Palantirs of the world. But there has been so much hype, as you know, and you know, Andrew, and some of these names that we've already referenced, the Droneshields, the Codans, the EOS. I don't think we need to go through exactly what all those businesses do because our audience is quite savvy. But is there any way to compare defense stocks here to what you've got overseas? Would you bother?
You can. I think if you go to the equivalence between, say, an L3 and someone like a Codan, where it's hardware, it's comms, it's systems, physical widgets that communicate data, I think what we don't really have are true primes here. So one, precisely because we're not small enough to carry one. Two, because you can get them off the shelf. And three, we have a relatively unique geography. So, you know, the having systems that are remote, like drones or autonomous kind of in the air and subsea kind of vehicles, and it is important. Whether or not that kind of makes itself manifest in valuations is something else entirely. So you then have to take a view is how many of these things do you need to sell and make before that value is realised. But I think more broadly, if you think an island country where we are, there's not a lot of land areas of ingress that you do truly need to defend. I mean, I joke, if someone wants to invade via Broome, it's really a long way to get to anywhere important, right? Uniquely. Whereas, you know, if you've got reasonable deterrent in the air and on the sea, kind of makes it a very kind of prickly porcupine to swallow.
But all of these companies on the screen now, Codan, Austal, Electro, Optic Systems, and Droneshield, I mean, they're all selling primarily overseas. I mean, yes, of course, you know, hopefully the Australian government is procuring locally while they can. But if you were sitting in a government department, to Andrew's earlier point, would you be looking at EOS, Codan? Do you think they're in it to win it?
I think if you look at some like Austal, relatively unique in that because they're shipbuilding, the government has taken a direct interest in terms of who owns it, how it's operated, and what some mechanisms might be, which is a more traditional government approach in Europe. So if you look at America's somewhat unique in that the primes are the primes are the primes. You know, Thales has majority French ownership. You know, BAE does have some interface with the UK government. Leonardo has a large Italian government ownership. So I think what I expect we'll see is as a true winner falls out of the comms cyber, I call it ISRW, like intelligence, kind of surveillance, reconnaissance, electronic warfare, that if there becomes a platform, so to speak, then I suspect governments will take positions.
All right. So we've got these four. I know that there's more, but these are the four that are sort of ahead of the pack. And some of their valuations have just been skyrocketing because it's been such a momentum play. So yeah, how do those figures stack up in your view? Because stability is something that's very difficult to come across in some of these companies that haven't even, I mean, you know, I think they've been all around for more than a decade, but, you know, not really selling.
Yeah. Effectively, if you're buying an Australian defence ETF, you're getting those four companies and some rats and mice because those four between them are sort of 95% plus, of the total Australian market cap in defence. Yeah. So from that point of view, whilst there are some small other defence players, this is the four when we talk about Australian defence or ASX defence that you're getting. I think it's interesting because when you look at them as businesses, if we can pull that back up, they are tiny in comparison to the ones we've just been talking about.
Yeah.
I mean, ignore market cap, but just look at sales and earnings. The biggest company in Australian defence right now is Codan, which did 103 million profit last year. It's a wonderful business, one we've owned for a very long time in Teaminvest. But that's $103 million of profit. The smallest of the others we've just looked at is about $1 billion a year. Yeah. So from that point of view, and that's in US dollars, not Aussie, so it's roughly a 15th of the size. And that 103 million of Codan's is about half from metal detectors in mining.
Yeah.
It's, you know, so the defense component of Codan is actually, you know, it's wonderful, but it's small, right? And that doesn't necessarily mean it's a problem, but you just need to be aware of that. If you think about our place in the world in defense as an Australian context, we are not going to be, I hope, at the pointy end of the materiel and the big land systems and the big ships, because there's just small population, and we hope we're not going to be in big combat. What we can do, though, and what we've been very good at doing in general across most of our industries, is finding niche use cases where our specific knowledge of things like rugged terrains, remote communication, satellite technology gives us a big edge. And that, if you have a look at where the 4 Australian successful defense companies play, that's what they're doing. Codan, it's all about mesh communications, which is something we had to do for mining, really, originally. Austal, shipbuilding around a very long coastline with small ships. Electro optical systems and Droneshield, same thing. The challenge then as a value investor is to say, okay, I can understand there's a niche here, but does it make sense for the price I'm paying? Now, normally when we talk about stability here and growth, you and I, we always speak about earnings stability and growth because that's what matters. The problem is most of those earnings are so small, as you can see, that you can't actually calculate that. So I've used here as a proxy sales stability. Now, sales and earnings aren't always moving hand in glove, but it's a better proxy than just saying not applicable. And as a result, what you can see is you can really see Codan is the standout company, but it's currently on a very, very high PE because of that interest in the theme. As a result, as a value investor, you'd probably say it's a company that you'd love to have owned back when it was $3 a share, but you're probably not prepared to pay $40 a share for today and wait for your opportunity. The others all have challenges. Now, different challenges. In the case of Austal, it's no growth. In the case of EOS and Droneshield, it's low stability and ridiculous PEs. But, you know, I like that Australia is trying to now finally step up to the global game in this way. But I think if you're an investor paying 907 times earnings for a company that makes $3 million a year in profit and has had governance issues, I wish you all the best, but that's not a gamble I'd take.
Yeah, okay. So can we summarize it by saying you need to apply the same rules of investing as a value investor to any company, even if it's in a sexy sector, even if it's in a sector that is supported by geopolitics, that is supported by a cycle outside of just pure economic growth?
Yeah, well, as a value investor, what you're trying to do is build a portfolio of wonderful businesses that generate you a very strong and growing earnings yield, which means you need high stability, a well-run company, earnings that are predictable, and you need to pay a reasonable price. And we've talked about this before, but the challenge when anytime something is sexy is the reasonable price side. The market runs away with that. Now, amusingly, and you know, with a crystal ball, most of those defense companies 4 years ago were trading on single-digit or low-teen PEs because defense was boring. We weren't going to have wars again. They were, you know, it was just purely preventative, you know, employment-driven. Now they're on triple-digit PEs. The time to have bought was 4 years ago. But if you understand this, you can get in if you like the sector when the opportunities arise. And maybe we have identified one today in Northrop, maybe not.
Now, Peter, just a final word. Do you anticipate that there will be more Australian defense companies coming to the fore, whether that be sort of old systems technology or new technology, or is it sort of not necessarily a game that we'll ever look to win?
I think we have to. If you think about what the force posture will look like over the next 10 to 20 years, and then how some parts of that industry have been cottage, and it's time to consolidate or die. So I certainly think that'll be happening. But I've had a view that the 6 words that you'll hear over the next 5 years, more than any others, are sovereign capability, and sovereign capability. So I think, you know, from what's come out in ministerial announcements to date and what will be coming, that will be the cornerstone. And, you know, and the race of life always been on a horse called self-interest. I think a very substantial part of that's going to be from here.
Peter Hasrouni, Teaminvest, thank you so much for bringing your expertise to the table. Andrew Coleman, I'm going to get you to stick around to answer your question if you don't mind, because, of course, you asked. Well, you too can ask the team a question. You just have to email us at wealthy@ausbiz.com.au. I keep my eye on the inbox, and I've treated Jean, because she's a regular viewer, for a view on another stock this week. She's asking about NNS, McMillan Shakespeare. So not in defense, but perhaps we're due for a bit of a breather from that. McMillan Shakespeare, this is one that is also, though, you could say, subject to change in regulation. You know, it's had a wild ride at times.
Yeah, I mean, look, a salary packaging company, right? Salary packaging and novated leasing. So amusingly, does actually do a lot of salary packaging and novating leasing for our defence personnel. So maybe we are still within the thing. Sorry, but it's tangential. It's not the core. Yeah. I mean, they're just a customer. Look, I like the space in general, and I like the space for two reasons. Number one of my very first jobs at university was actually at the call center of their main competitor, Smart Group. So it's something I've sort of known for a long time. But it's nice because we were talking about defense before. These are long-term contracts, they're steady, and they're ticket clipping. So inflation doesn't hurt them, it helps them, because as the value of each of these items, the novated leasing, the salary packaging goes up, their share for managing that rises nicely alongside inflation. The challenge really is, though, is that you've got one of two ways of growing in that space. You can grow by winning more contracts beyond just the standard slow increase in our public service, or maybe not so slow increase. Or you can grow by offering more products and putting your balance sheet on the line. And McMillan Shakespeare has chosen to grow by putting their balance sheet on the line. Effectively, they've bought vehicles and become the financier rather than just simply doing the ticket clipping. As a result, it's got two big risk profiles on it. The first is always the government changes the rules around salary packaging. I think that's relatively unlikely because, in the words of Yes Minister, that would be a very courageous decision. You know, all of the bureaucrats who have to pass the laws are currently salary packaging, so to have them take that away from themselves seems unlikely, but it could happen. But the second one is they've now effectively become a purchaser and lessor of vehicles, and that is a very unstable industry that goes up and down based on car prices. And with what's going on in the world right now, those cars may not be worth as much in 4 years' time when they come to the end of their lease as they were perhaps used and purchased for a few years ago. As a result, it's probably got too much risk. You know, it's got a debt to equity of over 600%. That's terrifying, not just a little scary. It's got reasonable stability, but effectively no growth. I mean, in 2016, they did 84 million of profit. They did 84 million of profit in 2024 and only a bit above that last year. So for an industry that's growing, they have not been the beneficiary. The good things, I suppose you'd say, reasonable return on capital and a very low PE, 12.7 times.
Yeah.
To me, Gene, I would say this is one of those that is maybe not an out-and-out dog, but it's certainly a zebra that's barking. I would avoid it. I think if you like the space, I'd prefer Smart Group.
Got it. Oh, and not just because you worked there.
And not just because
in the day.
Though there is absolutely an element of that too.
All right, Andrew Coleman, Teaminvest, thank you for answering our viewer question. Thank you all for watching. Please do send a question in for Andrew and the team to tackle next week. wealthy@ausbiz.com.au. Thanks for watching.
Wealthy and Wise is your guide to value investing, powered by Teaminvest.